smart capital in Telangana is moving west. Hyderabad's core real estate market has matured, pushing peak yields further out. Right now, the most aggressive capital is anchoring itself along the NH65 corridor. The target is the National Investment and Manufacturing Zone in Zaheerabad, a 12,600-acre project designed to operate as an autonomous, high-speed industrial city. The government is pouring over 11,000 crore rupees into the foundational infrastructure alone. That means heavy-duty paved roads, reliable water management, and dedicated power grids meant to sustain massive industrial output. That public infrastructure is bringing in private capital at a scale we rarely see. Hyundai is setting up an 82,500 crore rupee research and manufacturing campus here. We're talking about massive, high-capacity facilities like this one, built to handle heavy production loads and continuous supply chains. Mahindra is already here, expanding its footprint with a 1,000 crore rupee EV manufacturing plant to supplement their existing tractor production lines. Zaheerabad is rapidly shedding its agrarian history. The master plan relies on a strict cluster approach, segregating heavy manufacturing from logistics and residential zones, turning the area into a highly integrated industrial city. The tenant list goes beyond automotive. Companies like VEM Technologies bring aerospace and defense systems, alongside large-scale electronics assembly lines requiring high-density specialized labor. Combining billions in sovereign infrastructure spending with global corporate manufacturing creates a localized economic surge. This completely changes the baseline for land values. Facilities of this scale cannot operate in a vacuum. They require a massive workforce, and that workforce needs places to live, eat, and spend their paychecks. Over the next 15 years, this zone is projected to generate roughly 7.5 lakh jobs across direct manufacturing and indirect support services. This document shows the official projections. Looking at the high-growth scenario, the state anticipates over 2.66 lakh direct employment opportunities alone. Notice the timeline at the bottom. These employment numbers grow in steady increments through 2040, creating a long-term, high-density labor pool. That labor influx acts as a massive demographic magnet. Regional population models project the immediate area swelling from about 50,000 current residents to over 840,000 by 2040. To accommodate this migration, residential housing demand across the surrounding pockets of Sangareddy and Zaheerabad is projected to surge by roughly 1,500%. With that volume of demand on the horizon, the focus for an investor moves towards deployment strategy. Right now, early movers are choosing between two primary vehicles: traditional open commercial or residential plots and the rapidly growing category of managed farmlands. Your choice comes down to your personal investment timeline, your tolerance for illiquidity, and what you actually want your money doing while you wait. Let's look at the timeline. We are currently in the 2025 to 2026 awareness phase. The plans are public, but the heavy physical infrastructure is still being built. The critical window revolves around the 2029 infrastructure completion deadline. When these massive power grids and highway connections go live, the risk profile drops significantly. Historically, comparable corridors see a sharp 25 to 35% spike in land values during this final construction phase, before stabilizing into a mature, predictably growing market post-2029. To maximize that exact price spike, you want open plots along the NH65 corridor. This chart tracks the land value trajectory. At the NIMZ announcement in 2011, plots were moving at 2,500 rupees per square yard. Today, that average sits near 15,000, with data models projecting numbers climbing toward 87,500 by the time the market peaks around 2040. This table shows actual quoted prices. As companies like Mahindra set up shop, open plot prices surged from 300 rupees up to the 14,000 range. Data also reveals a proximity multiplier. Properties within 3 kilometers of these industrial zones capture significantly higher appreciation rates. But there is a clear trade-off here. Open plots generate zero lifestyle utility. You are buying raw dirt and waiting a decade for the economic gravity of the factories to pull your valuation up. For the pure financial optimizer who is perfectly fine holding an illiquid asset for 10 to 15 years, this is your vehicle for long-term wealth. But what if you want your capital to do something for you while you wait? That is where the second vehicle comes in: managed farmlands. These are large, professionally maintained, plantation-based plots. They sit further out from the heavy industrial zones, trading highway frontage for quiet agricultural space. You still benefit from the overall regional appreciation driven by NIMZ, but you also gain immediate weekend lifestyle utility and potential agricultural yields from the plantation. The trade-off is that you are sacrificing the absolute peak commercial pricing of a highway-adjacent plot in exchange for aesthetic value, clean air, and personal usage today. Instead of staring at an empty dirt lot near a construction site, you have a fully maintained green space to use with your family while the region develops in the background. Deciding between the two comes down to mapping specific goals against the growth timeline. If your sole objective is maximum return on investment and capturing wealth over a 10 to 15-year horizon, target open commercial or residential plots near the SEZ boundary. Conversely, if you want a tangible, usable asset to enjoy on weekends while steadily growing your net worth, managed farmlands provide that exact hybrid solution. Regardless of which vehicle you choose, the mechanics of this market are fixed. The 2029 development deadline is approaching fast, and in heavy infrastructure zones like this, getting in before the roads are finished is the single most critical factor in capturing the upside.